Welcome back, you legends. I'm Dr. Khan. Let's get right into this quick market update video. Yesterday, we had a bit of a counter rally in the first hours of the trading session. And then we saw that counter rally wane toward the end as the market gave back the early session upside. As has been the case during the last couple of weeks, the Dow Jones has beaten or outperformed the NASDAQ, the S&P, and the Russell 2000. If I take a look at the stock market map, we had a bit of a mixed look yesterday with surprising outperformance by Tesla and AMD. Nvidia still in the red. Big cap tech, Microsoft, Apple, Google still in the red. And we had a continued theme of consumer defensives, utilities, and healthcare. Defensive healthcare outperforming yesterday. Take a look at the different sectors. Utilities, defensives, real estate led the market, energy, basic materials, technology, communication services, and cyclicals lagged the market, even though we had that really brilliant outperformance by Tesla. Tesla continues to shine, in my opinion, even though the market has rotated defensively. Let's take a look at the daily chart for the S&P 500. We were trading within this range, topped a couple of weeks back after we produced this bearish divergence structure, consecutive higher highs, as the market was making consecutive higher lows, formed this wedge. We had a wedge breakdown the next day that called the top. We went on to make a double top formation, and then we had a breakdown out of this bearish consolidation / distribution pattern. As is usually the case, legends, when we get a huge bearish full-bodied candle like this, we tend to retrace back the middle of the candle. If I draw a Fibonacci retracement on top of the bearish breakdown, we can see that the 50% retracement is back at these prior lows. The middle of the candle, we went up to the 38% Fib retracement. We failed to clear that level. We might get there today. That is still possible, but the major trend is now down with this gap fill at 543 as the main target. So we could still get another bounce that fails at the 50% retracement level. These prior lows, this level is at, let's see, 557 roughly, but I would say that's a low probability event. And even if it happened, even if we got a rally like this, expect the following day to see a reversal, in my opinion, to fill this gap at 543. Obviously, when we get a breakdown pattern like this with consolidation at the low end of the pattern, it is very difficult to really call the sequence of events. For example, if I take a look at this distribution pattern, we will likely establish something that looks like this. This counter rally is very reminiscent of this counter move. We could get another move higher and still be in a bearish distribution pattern that ends up breaking to the downside. Again, if I take a look at this distribution pattern, very similar look, counter rally after a huge bearish candle. The counter rally continues for a couple more days, right? You see these slightly higher lows, even though the highs are pretty much equal highs, slightly higher highs, and slightly higher lows. Continues to form this bear flag pattern that ends up breaking to the downside. So that is still possible. We could still get a continuation of the move to the upside today. And if I take a look at the S&P 500 1-hour chart, we are now oversold enough for an oversold counter rally, for a short covering rally, a second attempt, potentially back to these prior lows, or maybe it just fails again at 555. So how to game plan this, how to trade this? One of two ways. You could wait for a back test of 555, then look for a rejection, right? Tombstone candles, gravestone dojis, double tops, things like that on the smaller time frames, maybe 10-minute time frame, and then a large bearish candle on the 1-hour chart that looks like this. That would be the signal to exit. If we don't get that signal at 555, then look for it to develop at these prior lows. 557, especially because that level is the 50% retracement level, bang right on at 557. That's in the case of a counter rally continuing today. In that case, I would look for something that looks like this, and then we continue lower the following day, or a slightly higher move, then we continue lower the following day. If today the data is bad right off the bat, because we do have a lot of data coming out today, this morning, ADP employment change at 8:15 a.m. Eastern Time, initial jobless claims, and ISM services PMI. This is a market moving number. This is a market moving event, another market moving. So we have 3 key data points today before the market open and after the market open. So expect a lot of volatility an hour before the market open and an hour after the market open. That should set us up for either a counter rally, again, another attempt, second attempt that fails, and then we get the sell-off either at the end of the session or tomorrow. Or if the data is bad enough, look for an open below these prior lows. If that happens, I think that sets up for a gap fill at 543. So if we get a gap down, that'll be a bearish signal to the downside for a gap fill. If we don't open with a gap down, look for another second attempt at 555 or 557 with a failure and then a sell-off either Friday or early next week. Again, stochastic and RSI both oversold enough to establish somewhat of a range like this. Multiple attempted rallies, the final one fails, and then we get the sell-off. Right? We are oversold enough. We are oversold enough for another attempt, for another counter rally attempt. Let's take a look at the NASDAQ 100. We are trading in a broadening wedge kind of structure. Resistance broadening to the upside, support broadening to the downside. This is a volatility expansion pattern. Usually we tend to get a bottom after we get a break of this support trend line. When we get the break, we should get a gap fill at 451, and that should give us a tradable bottom to the upside. Just like the S&P 500, I'll be looking for either a gap down for a continuation to the downside. If we don't get a gap down, then look for another attempted rally at 465 or slightly higher at 467. Just like the S&P, look for 65 to 67 on the S&P. Look for 55 to 57 for that second attempted counter rally failure. It is fairly rare for the market to just continue to sell off without multiple attempted, albeit failed counter rally attempts, usually establishing something that looks like a bear flag pattern, and then we get the second move to the downside. Let's take a look at the S&P 500 futures chart. It is oversold enough for another attempted rally. Typically, counter rallies in a downtrend will tag either the purple or blue moving averages. Still not quite there yet. The purple and blue are getting closer to the bottom of the range, which means we could get another attempted rally that fails at the bottom of the range. If that happens, that'll be a perfect breakdown and back test, bearish setup with a full measured move down to this prior range, these prior lows. That is around 5,437 for the S&P 500 futures. For the S&P 500 ETF, that level is going to be roughly at the gap fill level 543 all the way down to 537, the prior lows in this area. I'll be looking for a bottom to form somewhere in here for a tradable bottom. That could happen either late this week or next week. Take a look at the VIX. The VIX, as expected, as we discussed yesterday, when we get a huge gap up in the VIX, we tend to get a move down. That's exactly what happened. The result was a counter trend rally yesterday that did fail. In the next several days, we could either establish a range that looks like this, a range that looks like this, or we could continue to move down with slightly lower highs and lower lows. If that happens, usually when we get a move that looks like this, slightly higher lows and higher highs, we are much closer to the bottom. Because typically when this happens, you'll see things like the Dow Jones, for example, forming slightly higher lows as the S&P 500 continues to make slightly lower lows. Do you see the the bullish divergence here? Dow Jones continues to make slightly higher lows as the S&P continues to make slightly lower lows. This is a classic bullish divergence, and it calls the bottom as soon as we get a close above the 5-day moving average on the Dow Jones. That calls the bottom perfectly, and then we get a new uptrend. So if we start seeing something that looks kind of like this, so maybe gap up to start the day today, and then we move down, continue to move down the next several days, that means we're getting very close to the bottom. If instead we see something more complex, like this kind of structure, slightly higher lows and higher highs, then we're probably still a full measured move away from the actual bottom, right? If we see a structure that looks like this, slightly higher lows instead of slightly lower lows, then look for a big breakdown to come in at the end of this kind of bear flag. S&P 500 relative to gold, this is a risk on, risk off barometer. S&P significantly now underperforming gold. We're about to get a bearish cross on the PPO. Usually that signals a period of weakness, See that period of weakness when we get S&P underperforming gold. That usually means we are entering a period of weakness, correction, sell-off, whatever you want to call it. Dollar index up above S&P 500, down below. We did break below this key level. We had this backtest in the dollar index. It is now breaking down. That is positive for gold. A weak dollar is bullish for gold. If I take a look at the 10-year yield, we have now a double bottom potentially forming, as the 10-year yield will likely continue to move down. Expect TLT to at least move back to 99. So long-term treasuries down below. This is the 10-year yield up top. Look for TLT to continue to rally to $99, $100. Now, if we jump to the New York Stock Exchange Composite Index, we do have the McClellan Volume Summation Index about to produce a bearish cross. The McClellan Oscillator has entered bearish territory. Typically, this means we get additional downside. Typically, this means we've not bottomed quite yet, and we will have more downside ahead. NASDAQ Composite Index, McClellan Volume Summation Index for the NASDAQ Composite still looks bearish, about to cross down, suggesting more downside for the NASDAQ likely ahead. The oscillator has turned from green to red, also suggesting more downside likely ahead. If I take a look at the 50-day breadth, we had a breadth double top, and breadth is breaking down, again suggestive of additional weakness ahead. If I take a look at the 200-day breadth, looks even worse. The 200-day breadth, the Big Daddy breadth, looks even worse. To me, suggests still more downside likely ahead, regardless of what happens in the near term, the next few days, regardless of whether we form a bear flag, move sideways for several days, have multiple attempted counter rallies. The longer term trend indicators indicate that we are likely still away from a bottom, and a gap fill at 543 remains the ultimate destination in the medium term. Down below is the 10-2 yield curve. Up top is the S&P 500. Yield curve inversion tends to precede recessions, and then normalization on inversion tends to call market top. Sometimes it happens right after a market top, sometimes a few weeks ahead of a top, right? Sometimes a few weeks ahead of a top. We are now inching closer to yield curve normalization. That typically means we are 3 to 6 months away from a major market top. If I take a look at XLP, that is S&P 500 Consumer Staples, defensives, massive breakout, continued higher lows and higher highs, much stronger than the S&P 500. This is obviously bearish. This is a defensive rotation. And when this defensive rotation ends and you get the top in XLP, typically what happens in that case, you see a broad market sell-off where all defensives and offensives, risk on, risk off, every sector in the market tends to crash and drop toward the end of the sell side cycle. Typically the last week you see everything drop. And I'll give you a direct example of this happening. If you take a look at the October, we actually take a look at the October bottom in 2023. Take a look at this. Staples completely crashed. That typically happens toward the end of a sell cycle. If I take a look at the October bottom of 2022, again, look at this. Staples went down with the market just as bad as the market. So this is one of those times where actually Rotating into staples is probably a bad idea. Staples massively overbought, likely topping in the next couple of days, maybe a week, and then look for staples to drop with the rest of the market. CNN Fear and Greed Index, we dropped from greed into neutral. We topped at 63, similar to previous tops at 63. Fear and greed still neutral, not at fear yet. Market momentum is dropping down. Stock price strength, this is a lagging indicator. You will see it flatten and move down. Breadth is moving down, and then the put to call ratio is rising, suggesting more downside is likely ahead, that the sell-off is not over quite yet. Market volatility potentially just pulling back slightly in the near term. That means potentially again today we could get another counter rally, but the longer term trend does look like the VIX will continue to rise, and we're not at a bottom for the S&P or a top for volatility quite yet. Today we have the ADP employment change number at 8:15 a.m. Initial jobless claims 8:30 a.m. ISM services PMI 10 a.m. All of these are market moving numbers. Weaker than expected employment, higher than expected initial jobless claims will be bearish, and ISM services PMI lower than expected number will also be bearish. The opposite is also true. ADP employment change, if it's better than expected, that's bullish. Initial jobless claims, if it's lower than expected, that's bullish. ISM services PMI, if it's better than expected, that is bullish. This is the bullish percent index for the S&P 500. Notice how it is curling down, suggesting yes, more downside is still likely ahead. Up top is the S&P. Below it is the bullish percent index, and the bullish percent index for the S&P 500 is now curling down, suggesting more downside is likely ahead. The NASDAQ Cohen high-low index again curling down, just like it did in the July top, suggesting more downside is still likely. So in summary, near term, look for either one of two things, either consecutive lower lows and lower highs. In that case, it will be much closer to an actual tradable market bottom. If instead we get another counter rally today, then look for a failure at 555 or 557 for the S&P 500, and then for a bear flag to form with a breakdown coming in either late this week or early next week. If you watched till the end and you enjoy this content, please smash that like button right in the face. If you want to support the channel and get access to all of my trading activity and real-time market analysis, check out Money Time Machine on Patreon to become a member of the Money Time Machine trading community. If you watched till the end and you did not enjoy the video, I still thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next.
Oh, wow.